Welcome to Zuzang Kaijing. We are committed to providing the most accurate, valuable, and timely information and analysis.
And hello, everyone. Right now, it's Monday, August 11th. That's 9 p.m. here on the East Coast, or 6 p.m. for listeners out west.
Today, we're diving deep into, well, a really fascinating stack of recent news and reports. It's like a snapshot of everything happening right now.
Global markets, corporate moves, economic policies. It's all in there.
Exactly. And our mission really is to connect those dots for you, uncover what's hitting beneath the surface.
And give you that shortcut, to being genuinely well-informed in all this complexity.
Precisely. We'll be navigating a whole range of topics today. Think central bank decisions, those ongoing trade tensions, specific industry shifts, corporate strategies, lots to cover.
Our goal is basically to take all these different pieces and weave them together, make a coherent story out of it.
Showing not just what's happening, but more importantly, why it matters to you.
And what it might mean down the road. #I. The intertwined world of trade, tariffs, and monetary policy. #A. The shifting sands of global trade and tariff battles.
Okay, so to kick things off, let's unpack this high-stakes diplomatic dance that's been going on, the Japan-U.S. tariff talks.
Right.
Our sources mention Japan's economy minister, Ryo Akazawa. He made 9 visits to the U.S. That sounds like a lot.
It was a lot. An astonishing number, really. Almost constant shuttle diplomacy.
So what was the core issue? I mean, what was so urgent that it needed 9 trips? What was really at stake for Japan?
Well, it was an incredibly intense period. Your sense of urgency is right on the money.
Okay.
Akazawa's persistence, it was absolutely crucial. The main goal.
Yeah.
Reaffirming Japan's most favored nation status with the U.S.
Most favored nation, like getting the best deal.
Exactly. It ensures you get the best tariff rates they offer anyone else. The big worry, the thing hanging over them, was the potential for the U.S. to slap on significant new tariffs.
Not significant.
We're talking a potential 100% tariff on all semiconductor imports from Japan.
Wow, 100%.
Yep, and additional tariffs on pharmaceuticals, too.
Yeah.
These were things former President Trump had actually announced.
That sounds devastating for Japan.
Absolutely. For a tech-heavy, export-driven economy, it would have been catastrophic. So the huge relief came with the agreement that the much lower 15% tariff rate.
The one the U.S. has with the EU.
That's the one. That rate would likely extend to Japan.
Yeah.
So it was a major de-escalation. They dodged a massive bullet.
Moving from 100% to 15%, yeah, that's a huge difference. But I read something interesting about Toyota getting involved.
Yes.
It was just government officials, right? How does a company like Toyota play a role in these kinds of talks?
That's where it gets really fascinating, where corporate power and government diplomacy kind of blur. Akio Toyoda, Toyota's chairman, he presented what was essentially a negotiation card to Prime Minister Ishiba.
A negotiation card? What was it?
It was a concrete offer, a proposal for Toyota to actively import U.S.-made vehicles into Japan.
Oh, interesting.
Think about the strategy there. It was a really smart move, designed to show a clear commitment from a major Japanese company to U.S. interests.
Right. A tangible gesture.
Exactly. A way to ease some of that pressure from the U.S. and show, tangibly that Japan was willing to help balance trade, not just with words, but with actual business decisions.
Offering a win directly from a private company. That's clever.
It can be more persuasive sometimes than just government promises.
Okay, so that's the high-level negotiation. But what about the broader impact of these tariffs? Beyond the trade numbers themselves, I'm seeing things about corporate profits taking a hit.
Absolutely. And that's critical because it shows how these policy shifts ripple out into the real economy. It's not just abstract.
So companies are actually feeling it.
They really are. Take Olympus, for example.
Yeah.
Big name in optics, medical tech.
Right.
They had to revise their net profit forecast down by 20%.
20%? That's huge.
It is. And they explicitly blamed tariffs for $26 billion of that reduction. It shows how these big policy changes hit the bottom line hard.
So what are companies doing? Just absorbing the costs, or are they making bigger changes?
Oh, they're making fundamental changes. We're seeing proactive, long-term strategic shifts.
Like what?
Well, look at Shionogi, the pharmaceutical company. They're planning a whole new antibiotic plant in the U.S.
In the U.S.?
Specifically to bypass these tariffs. They're aiming for January 2029.
Wow.
It signals more than just coping, right? It's like a paradigm shift. That old model of just-in-time global supply chains for lowest cost, that's giving way to just-in-case resilience.
Building resilience, not just efficiency.
Exactly. Companies are rethinking everything, reshoring, diversifying manufacturing. It's redefining what being a global company means. It's expensive, but necessary now.
Fascinating. A physical plant built just to navigate trade rules. Okay, switching gears a bit, what's the latest on the U.S.-China tariff front? Are things easing up there at all?
Well, there's a temporary reprieve, you could call it. But easing might be too strong.
Okay.
President Trump signed an executive order just on August 11th. It extends the deadline for some U.S.-China tariffs by 90 days. The original deadline was August 12th.
So it avoids immediate escalation.
Right. Which is good for short-term market stability,
Yeah.
but it's definitely not a resolution.
Still tense, then.
Very much so. Trump also took to social media, urging China to buy more soybeans. It shows the negotiations are still uncertain, still demanding.
Classic Trump move, keeping everyone guessing.
Pretty much. So the immediate conflict was avoided, but the underlying tensions, they're still very much there.
Okay, let's unpack this shift we're seeing in global monetary policy. Central banks are really in the spotlight, lots of movement on interest rates, especially starting with the ECB in Europe. What's the story there?
Indeed. Europe's rate cuts, well, they were kind of ahead of the curve for a while.
All right.
But now it looks like they're entering the final phase. Speculation's really ramping up that the ECB might just stop cutting.
Stop cutting altogether.
Yeah. We're hearing from figures like Robert Holzmann, the Austrian central bank governor. He actually said quite clearly, there is no longer any reason to cut rates.
Wow, that's pretty direct.
It is. It's a hawkish stance, especially since his term is ending. It signals, a potential end to this easing cycle for the ECB, a real sign of growing caution.
So how are the markets reacting to that kind of talk? They're always trying to get ahead, right?
Oh, swiftly. As you'd expect. Barclays, for example, they've already pulled their forecast for a September rate cut.
Really?
Yep. And Goldman Sachs. They're now saying the rate-cutting cycle is over. Their base case is the ECB holds the rate at 2%.
That's a big shift from what people expected earlier.
Huge adjustment. Markets were pricing in at least one more cut. So now, investors are rapidly repricing assets based on this idea that the ECB might be done easing for now.
So what's driving this change of heart at the ECB? Is it just inflation hitting their target, or is it more complicated?
Oh, it's definitely complex. Monetary policy always is, right?
Yeah.
Like juggling. Inflation has aligned with their 2% target, which is good. But there are still underlying concerns.
Like what?
Well, the threat of Trump's tariffs, for one. Even with these temporary deals, it creates divisions inside the ECB about how to assess the risks. Makes it harder to get a unified view.
Okay.
And on the growth side, Eurozone GDP in Q2 was actually positive. That eased some of the earlier pessimism. Plus, Germany's planning fiscal stimulus in 2026, which should help growth.
So they're balancing inflation control against growth stability.
Exactly. It's that delicate balancing act. And it's a dilemma we're seeing in other major central banks, too. It's a global thing.
Makes sense. Are other central banks facing similar pressures, these kinds of internal disagreements or shifts?
Absolutely. It's not just Europe. Look at Switzerland. They were the first major bank to start cutting rates back in March 2024.
I remember that.
Now, there's growing speculation they might halt their easing cycle, too. Similar pressures.
And the Fed?
Closer to home. Yeah, the Fed's meeting in late July. It saw two officials dissent in favor of a rate cut.
That's rare, isn't it?
Haven't seen a split like that in 32 years. It really shows the depth of disagreement about the right path forward.
Wow.
And the Bank of England. Their recent quarter-point cut was a super narrow 5-4 vote. Again, high inflation concerns in the UK.
So lots of internal division everywhere.
Widespread division. It suggests a much more cautious, slower pace of cuts ahead. They're struggling with confidence, partly because these trade policies keep shifting, making it incredibly hard to gauge the impact on growth and inflation. It signals an end to that predictable, synchronized central bank playbook.
A new era of policy divergence.
Exactly. Investors can't assume a unified front anymore. It forces a rethink of currency and asset strategies.
Speaking of the Fed, there's always buzz about the next chair. Powell's term ends in May 2026. Any names emerging, especially with the election cycle?
Yeah, the Trump administration is definitely looking at candidates. Some notable names. James Brad, former head of the St. Louis Fed, known as a monetary hawk.
Hawk meaning favors tighter policy.
Right. Suggests a preference that way. Another name is Mark Summerlin, who advised former President George W. Bush.
Okay.
Others considered before include Kevin Warsh, Kevin Hassett, and current FRB Governor Waller. Waller is actually emerging as a strong contender lately.
Interesting.
Treasury Secretary Bessent is overseeing the process, but ultimately it's President Trump's call. The market seems to see this as more of a 2025 issue, though. It's on the radar, but not driving things day to day right now.
Okay, so lots of uncertainty around policy and politics. How's this hitting currencies? What about the Japanese yen? That's often a safe haven.
Well, the yen is actually expected to stay pretty firm this week,
Why is that?
mostly due to those persistent expectations of an early Fed rate cut. FedWatch, the tool tracking predictions.
Right.
It's showing an 87% probability of a quarter-point cut at the September FOMC meeting.
So the market's really expecting it.
Pretty strongly baked in. But, and this is important, that upcoming U.S. inflation data, that could definitely trigger volatility. So firmness isn't guaranteed, it's sensitive.
So if the Fed's expected to cut, wouldn't that normally weaken the dollar? What's the story with the dollar versus the yen?
That's where it gets a bit nuanced. The dollar's recent depreciation, that momentum, seems to be weakening.
Oh.
Algorithmic trading systems, the ones that follow patterns, they're actually starting to buy dollars, especially against the yen.
So the early August jobs report shock might have been overdone?
It suggests that, yeah,
Uh-huh.
or other factors are now more dominant. While that policy diverges U.S. cutting, Japan maybe hiking could eventually strengthen the yen.
Right.
In the short term, the absolute interest rate differences still favor carry trades.
Carry trades. Can you quickly break that down? What is a carry trade?
Sure. Basically, it's a strategy. An investor borrows money in a currency with a really low interest rate, like the yen right now,
Okay.
and then invests that borrowed money in a currency offering a higher interest rate, like the U.S. dollar, maybe the Australian dollar.
To profit from the difference.
Exactly. You earn the difference, the carry. So even if the Fed cuts, U.S. rates are still much higher than Japan's. That keeps the dollar attractive for these trades.
Got it. So that yield difference kind of puts a cap on how much the yen can strengthen, even with expected U.S. cuts.
You got it. Makes perfect sense.
So with all this rate talk, everyone's waiting for the U.S. CPI data on August 12th. What's the expectation for that big inflation number?
That's the big one, absolutely. A potential market mover. The July CPI, specifically the core index, which excludes energy and food.
Gives a clearer underlying picture.
Right. It's expected to show a slight acceleration, projected to rise more 0.3% month-on-month. That's up from 0.2% in June.
And why the acceleration?
It's largely thought to be the impact of those U.S. tariff policies finally filtering through more strongly, as inventories bought before the tariffs run out.
Okay.
However, if the numbers just land within expectations, given other signs like the slowing labor market, well, speculation about a rate cut could actually intensify.
Because it wouldn't be a huge upside surprise.
Exactly. The market's already priced in about 2.3 rate cuts by the end of the year. So data reinforcing that outlook will be watched very closely.
And how are bond markets holding up amidst all this policy uncertainty, inflation watch? What's the mood there?
U.S. bond markets, they're pretty flat, actually.
Mm-hmm.
Kind of cautious. The 10-year Treasury yield is steady around 4.28%. Investors are just waiting for that CPI data.
Wait and see mode.
Classic wait and see. In Japan, long-term bond rates are bouncing around 1.5%. The Bank of Japan's July meeting minutes sounded pretty hawkish.
Fueling rate hike expectations.
Yeah, which naturally puts some upward pressure on yields there. Over in Europe, German 10-year yields are up slightly, around 2.6%, partly due to those U.S. tariff worries hitting Europe.
Mm-hmm.
Meanwhile, UK long-term rates dipped a bit, around 4.5%, ahead of their own economic data. So it's kind of a mixed picture globally, all very sensitive to these intertwined factors. Hashtag tag tune pal. Corporate maneuvers and industry shifts.
Mm-hmm.
Hashtag tag Teddy. The ever-evolving tech and semiconductor landscape.
All right, let's shift focus now to the tech sector. AI chips, obviously, are a huge topic. And there's this really interesting, almost unprecedented development with Nvidia and AMD selling into China. What's the story there? Sounds like a unique fix.
It's a truly significant story, yeah, with big implications for how tech giants handle geopolitics now.
So what happened?
Both Nvidia and AMD have reportedly agreed to a very unusual deal. They'll pay 15% of the revenue they make from selling AI chips to China, directly to the U.S. government.
15%. Just
Yep.
hand it over.
Yep. It sounds strange, but this agreement is basically the key that unlocks the resumption of export licenses for their critical chips, like Nvidia's H20 and AMD's MI308.
Without the licenses, they couldn't sell those chips to China at all.
Exactly. Couldn't ship them.
So it's a trade-off. They get market access, but it costs them 15% off the top, like a geopolitical toll fee.
That's a good way to put it. A toll fee or maybe a new kind of compliance cost.
Yeah.
And while it definitely raises concerns about profit margins in China,
You'd think investors would hate that.
well, the certainty of being able to ship again has actually spurred buying interest in their stocks.
Really? Certainty trumps the margin hit.
It seems so. Investors prefer a predictable, even if lower, revenue stream from China over being locked out completely.
Mm.
Nvidia put out a statement emphasizing compliance,
Mm.
but also stressed the need for export rules that let U.S. firms compete globally, saying U.S. AI tech needs to be the global standard. They were worried about companies like Huawei gaining ground if U.S. firms were totally blocked.
So it's threading a needle, maintain leadership, allow some access.
Exactly. It's a fascinating example of adapting to this new era of weaponized interdependence, as some call it, where economics and national security are just tightly linked.
Weaponized interdependence, that really captures it. Okay, shifting within semis, memory, Micron Technology stock has surged. What's driving that positive vibe for them?
Yeah, Micron stock jumped a solid 7% and kept climbing. That's often a good sign for broader tech demand.
So what's behind it?
It's mainly driven by them revising their earnings forecast upward for the June-August quarter. They specifically mentioned improved market conditions, particularly for DRAM.
A DRAM being the main type of memory chip.
Right. Crucial for everything. Their revenue guidance was lifted significantly, earnings per share too. Both beat what the market expected. Signals a healthier market.
Is this also tied to AI demand, like the Nvidia AMD story?
Partially, yes.
Yeah.
Definitely related. Demand for HBM, high bandwidth memory.
The stacked memory for AI.
Exactly. That demand is exceptionally strong. It's a direct beneficiary of the AI boom. Plus, there's been speculation that China's main DRAM maker, CXMT, might halt production of some products.
Ah, so tightening supply.
Potentially. That's heightened awareness of a tightening supply-demand balance globally. That pushes up prices, boosts Micron's profits. So strong AI demand plus tighter supply, very favorable for Micron right now.
But it's not all sunshine in AI land, is it? C3.ai, the AI software company, it took a massive hit. What went wrong there?
Yeah, C3.ai plummeted, a real free fall, down 25.5%.
Ouch.
It was triggered by their preliminary earnings report for May-July. It just fell way short of expectations. Revenue is projected to decline 19–20% year-on-year.
A decline for an AI company now, that's bad.
Disastrous for a growth-focused tech firm. And to make it worse, the CEO, Tom Siebel, cited health issues limiting his involvement and announced he's planning to resign.
Oh, wow. Leadership uncertainty on top of bad results.
Huge uncertainty. Analysts reacted quickly. Downgrades, calling the results disastrous. It's a stark reminder, right? Even in a hot sector like AI, individual company performance varies wildly. Promises don't always equal profits.
Definitely. Now, a surprising twist for Intel. Former President Trump seems to have done a complete 180 on their CEO, Lip-Bu Tan.
Indeed. Quite the public turnaround. Intel stock actually ticked up after Trump met with CEO Tan.
But didn't Trump demand his resignation before?
He did, very publicly, which is pretty unusual, attacking a private sector CEO like that. But after the meeting, Trump totally reversed course. Praised the meeting, called Tan's success an amazing story.
And this meeting included cabinet secretaries.
Yeah, Commerce and Treasury secretaries were there. So this shift has fueled hopes that better relations with the administration could help Intel's big restructuring efforts.
Because Intel is key to U.S. chip manufacturing plans.
Exactly. Getting political alignment is crucial for their huge investments. It really shows how political wins can directly sway market perception and corporate strategy, especially for companies so central to national tech policy.
What about SoftBank Group? Often seen as a tech investment bellwether with their Vision Fund. How are they doing?
SoftBank's shares really soared, up 8%, hit a new record high since listing.
What's driving that?
Two main things. First, the strong performance of ARM Holdings, their UK chip design subsidiary. ARM's doing incredibly well in the AI era.
Right.
Second, they're riding that broader rally in U.S. tech stocks. Plus, there are rising expectations for the value of their stake in OpenAI.
A generative AI firm.
Yeah. Analysts are bumping up SoftBank's target price based on those AI prospects. And Reuters reported SoftBank has hired banks for a potential U.S. IPO of PayPay, their big patent platform.
So, more activity coming.
Signals more potential monetization. Looks like their big bets on AI and digital transformation might finally be paying off well. Hashtag tag BB. Financial services navigating new waters.
Okay, moving from tech shifts to financial services, they're dealing with their own challenges like data security, but also some interesting sustainable investment moves. First, this concerning story about Nippon Life and a data leak from Mitsubishi UFJ Bank. What's the latest there?
It's quite serious, yeah. Really highlights the risks in data sharing between big financial players.
What was discovered?
It looks like a folder with leaked info from Mitsubishi UFJ might have been deleted by Nippon Life after they started their own internal investigation.
Deleted. That sounds suspicious.
It does. This data, taken by an employee seconded from Nippon Life to Mitsubishi UFJ, it was sensitive stuff.
Like what?
Sales performance criteria for insurance sold at bank branches, details on competitor product changes. And the troubling part is, Nippon Life then apparently used this info for their own business. Now, authorities think the data is recoverable, and the deletion won't stop the probe. But the Financial Services Agency is taking it very seriously. Ordered Nippon Life to submit a detailed report by August 18th.
Big breach of trust and security practices.
Absolutely. Raises serious questions about compliance and ethics.
Okay. On a more positive note, Mizuho Financial Group has this interesting new strategy linking finance and sustainability. What's their plan?
This is genuinely pioneering for a huge bank like Mizuho. Could set a new standard.
How so?
They're planning a massive investment, 200 billion yen over 5 years, starting next fiscal year.
Investing in what?
Specifically in energy-saving upgrades for used buildings, targeting properties over 20 years old, which are often less efficient.
So green renovations.
Exactly. They've set up the Mizuho Green Recovery Fund. The goal is to boost the environmental performance of these older buildings. The LED lighting, modern HVAC systems.
And then what?
Make them more valuable, more sustainable, and then sell them to investors or REITs for a profit. Their first project is the Panasonic IMP building in Osaka, bought for about 50 billion yen.
So it addresses rising construction costs, too, by focusing on upgrades.
Precisely. It tackles market competition by adding value through green renovations, not just new builds. And it clearly shows how finance can drive environmental goals. Pretty innovative. Hashtag C, diverse economic and industry highlights.
Okay, here's one that caught my eye. Japanese mackerel can production has halved in just 5 years. That's a huge drop for a staple food. What's going on?
It's a genuinely concerning trend, yeah. Especially for a country where mackerel is so important diet-wise, and it points to bigger issues.
How bad is the drop?
Domestic catches are down 40% in 5 years. 40%.
Wow.
And on top of that, import prices for foreign mackerel have doubled in the same period.
So processors are squeezed from both sides.
Hugely squeezed. Struggling to get raw materials. Some are actually shifting to making tuna cans or even rice and meat cans just to keep the lights on. It's a real food security issue.
So if catches are down and imports are too pricey, what's the long-term fix? Are they just giving up on mackerel?
No, they're looking urgently at full-cycle aquaculture. Basically, fish farming from egg to adult.
Farming mackerel.
Yes. There's the Saba Ibaru project. Saba is mackerel, Ibaru means thrive.
Okay.
The goal is pretty cool. Breed hybrid mackerel fry. Cross northern and southern types to make them more resilient to heat and disease.
Hybrids for resilience. That's interesting.
Yeah, supported by government funding. They hope to distribute these fry nationwide by 2028 to keep mackerel on Japanese tables.
And what caused the original decline?
It's a mix. Rising sea temperatures messing with ecosystems, plankton shortages, their food source, and, sadly, past overfishing depleting stocks.
So the mackerel story is really about climate change and sustainability impacting food.
Exactly. It's a stark, very tasty reminder of how these big global issues hit home, affecting food security and traditional industries everywhere. How do we innovate to secure basic resources? That's the challenge.
Powerful point. Okay, shifting to a different kind of resource. Human talent. Japan's Ministry of Health, Labor and Welfare is apparently bringing back former staff, embracing alumni. Why is that happening now?
It's a very telling sign, actually. And yeah, it points to a talent crisis within Japan's bureaucracy.
Oh, crisis.
Well, that ministry, the MHLW, it's sometimes grimly nicknamed the Ministry of Forced Labor.
Oh, really? Why?
Notoriously heavy workloads, high resignation rates, so they face critical talent shortages. Now they're actively rehiring former staff. Simplifying the process, doing more outreach.
Trying to get experienced people back.
Exactly. The idea is alumni, maybe folks who went to the private sector like Kazuhiro Morita, who returned with digital healthcare experience, they can contribute immediately, bring fresh skills.
Does it solve the underlying workload issue, though?
That's a good question. There are still challenges, like rank disparities for returnees under current rules. But the National Personnel Authority supports simplifying rehiring from 2026. The hope is diverse experience revitalizes the bureaucracy, tackles that brain drain.
Okay, let's talk gas prices, something everyone feels. There's a push in Japan to scrap the provisional surcharge on the gasoline tax. Sounds good for drivers, but what are the hurdles?
You're right, sounds like a simple win for consumers. And both ruling and opposition parties actually agree on getting rid of that surcharge. It's 25.1 per liter by year end.
So why is it hard?
Three big hurdles. Makes it a real political tightrope. First, where does the money come from? That surcharge brings in about 1 trillion a year.
₦1 trillion. Wow.
Finding that elsewhere means other tax hikes or cutting benefits, which could cause backlash. Second, what about diesel? The gasoline tax gets priority, but the diesel tax, 17.1 per liter, entirely funds local governments, about 500 billion annually.
So cutting that hurts local finances.
Severely. But keeping it while cutting the gasoline tax could make diesel more expensive than gasoline, which would be weird and unpopular.
Okay, tricky. And the third hurdle.
Just managing the transition. A sudden price drop. People might stop buying gas right before, then rush to buy right after. Disruptive. Gas stations need refunds for inventory bought at the higher price.
So how to smooth it out?
Opposition parties suggest gradually increasing subsidies up to the old 25.1 level to ease the drop, but that also needs funding. So, yeah, balancing relief and fiscal health is tough.
Really lays out the complexity. Okay, on a more positive note, MAFF, the Ministry of Agriculture, Forestry, and Fisheries, has an initiative connecting local governments with private companies for rural revitalization. What's the plan there?
Yeah, this looks quite promising. MAFF is linking local governments with private firms that have advanced know-how.
Like who?
Companies like Timee, a job platform connecting workers to farm needs, and Sandrai, which uses satellites for farmland analysis. Data-driven farming insights.
So technology and flexible labor for agriculture.
Exactly. The goal is to boost productivity, expand sales channels for rural products, and create a model they can replicate nationwide. They're picking about 30 municipalities to start by September.
Addressing long-standing rural issues.
Right. Labor shortages, rising costs, climate change adaptation. MAF is acting as a bridge, fostering collaboration for mutual growth. It's also seen as a way to boost community engagement in areas facing decline.
Great example of public-private partnership. Okay, let's wrap this section with some quick corporate earnings hits and industry snapshots. What stood out?
Okay, quick hits. McDonald's Japan, hitting a year-to-date high on the Tokyo Stock Exchange.
Really? Why?
They revised their FY 2025 profit forecast upward, now expect only a 3% decline, better than the 5% drop they first predicted.
What drove the improvement?
Operational efficiency, like self-order terminals, and strong first-half sales, helped by price hikes and those IP collaborations, popular characters and promotions.
Interesting. What else?
The August Quick Tankin survey measures business sentiment, showed a slight dip in manufacturing for the first time in 2 months. DI down 2 points to plus 15.
Still positive, but less so.
Right. Non-manufacturing dipped slightly too. Interestingly, 59% of companies see only a limited impact from that U.S.-Japan tariff deal, maybe adapting faster than feared.
And what policies do businesses want post-election?
Top hope is active fiscal policy to tackle rising prices. That was 37%, followed by promoting investment in strategic areas like chips and AI at 18%.
Okay, last one.
July money stock data from the Bank of Japan. M3, a broad money measure, up 0.6% year-on-year, fourth straight month of growth.
What's driving it?
Well, cash currency declined 1.8%. That cashless trend continues. But quasi-money, like time deposits, rose 3.8%.
People moving money for higher interest rates.
Exactly. Higher rates encouraging shifts from ordinary deposits. Shows both the cashless move and how interest rates influence saving behavior directly. #3. Market performance and future outlook. #A. Global market snapshot.
All right, so given all these moving parts, trade, policy, companies adapting, how are the global markets taking it all? Let's get a snapshot, starting with the U.S. stock market.
Okay, the U.S. market.
Yeah.
The Dow Jones has been pretty mixed. Often opens higher, then sees some profit-taking, especially in tech stocks.
Why the selling?
Well, investors are definitely waiting for that CPI data we talked about. There's also just general uncertainty about tariffs, caution about high valuations.
Yeah.
It leads to choppy trading.
And the NASDAQ.
The NASDAQ did hit a record high recently, which is impressive, shows tech strength is still there. But it's also showing some signs of being a bit overheated. So potential for pullbacks maybe, balancing optimism with caution.
Okay. What about commodities? Crude oil, gold, they've been jumpy.
Yeah, in commodities. Crude oil futures saw slight gains, mostly position adjustments after recent falls. But markets are really cautious ahead of that U.S.-Russia summit on August 15th.
Why the caution?
Could impact oil supply, depending on ceasefire talks, sanctions, production. Lots of unknowns. Gold, meanwhile, fell sharply after spiking earlier.
What caused that volatility?
It was triggered by speculation, surprising speculation, that U.S. customs might put tariffs on gold bullion.
Tariffs on gold. Seriously.
Yeah, pretty unprecedented rumor. But then President Trump posted on social media, no tariffs on gold. That calmed things down, led to profit-taking. But it shows how sensitive commodities are to tariff talk, even rumors.
Definitely. Okay, let's bring it back to Asia. How is the Nikkei average doing in Japan? What's the mood there?
The Nikkei is doing well, actually, nearing its record high from July 2024, showing real resilience.
What's boosting it?
Corporate earnings for April-June came in largely better than expected. People were quite pessimistic initially, partly due to tariff fears.
So better earnings cleared the air.
Yeah, eased concerns, boosted optimism for future profits now that companies seem to be navigating things. Big names like Sony, SoftBank, even domestic demand stocks are doing well. Broad strength.
So the mood is positive.
Cautiously positive. There's still some debate among analysts about risks down the line, but overall the focus is on stronger fundamentals, the managed trade de-escalation. Some expect the summer rally there to continue.
So summing up the market mood, despite lingering worries on tariffs, inflation, central bank divisions, it's cautiously optimistic, especially in Japan.
Fair.
Yes, I think that's a very good summary. The market's balancing positive earnings momentum and reduced tariff fears against potential inflation flare-ups and signs of a global slowdown. It's a delicate balance, a tightrope walk, but yeah, for now, optimism seems to have the edge, especially seeing how companies are adapting.
Wow, what a deep dive. We've really covered a lot today. From that intricate dance of tariffs and diplomacy to the push and pull inside central banks, the smart moves companies are making, even how it hits things like mackerel supply.
It really shows how interconnected everything is, doesn't it?
Absolutely. A single tweet, a subtle policy shift, ripples everywhere. And you really see the insights when you connect the dots, right?
Yeah.
Seeing these news items not in isolation, but as pieces of a bigger picture.
Like Shinogi building a plan in the U.S. just to get around tariffs.
Exactly. Or Mizuho using green real estate upgrades as a core strategy. It shows businesses adapting creatively to this changing world of trade pressures and economic shifts.
Understanding these connections feels key now.
It really is. The future of global commerce, investment. It hinges on grasping these nuances, how companies and governments react to these, frankly, unprecedented challenges.
So for everyone listening, trying to make sense of this complex economic picture, what's the takeaway?
Well, it raises a big question, doesn't it? In a world where every bit of news feels like a potential domino,
Right.
how might all these seemingly separate things we discussed, macro shortages, AI chip deals, central bank splits, election outcomes, how might they collectively shape the global economy over, say, the next 12 to 18 months?
Especially with that ongoing tension between inflation, growth, and trade policy.
Exactly. How do these pieces combine to create a new economic landscape? Something to really think about until our next deep dive.
Fascinating food for thought. And that's all for this deep dive. Thank you for joining us on Zhu Jing Pu Jing. We hope you feel a little more well-informed.
And hopefully a lot more curious.